I think like personally, like right now, the only thing is that it's just Trump. It's just Trump's administration. You know, I don't think like they're the ones that's saying that he's doing a bad job. Like obviously it's to me it's just no right or wrong answer, you know. If he cuts rates too early, we'd have been dealing with higher inflation 3-4 months ago, right? If he waits too long, obviously you're going to put strain on the economy. So it's like regardless, they're going to talk bad about him anyway. There's nothing that he could do, you know, it's never a perfect, they can never be perfect because it's a cycle. So they have to always try to make the best decisions possible during the cycle, but also the government have decision makings in that as well, right? The government, how they do their government spending and all of that stuff could cause even more problems. Wars could pop off, right? Because they can't control politics, you know, so stuff like that makes it even like a little more difficult for their job. Exactly, Breven. So that's what it is too. So they're supposed to work hand in hand, but it's like, how could you work hand in hand with somebody like Trump? Because he wants interest rates at zero, but it's like there's still high inflation. How does the president know when? Does he go to the grocery stores? I doubt it. You think he ever focused on his rent, his car notes and stuff like that? I doubt it. So you can't rely on politicians to tell us how our bills are supposed to be paid and stuff like that, because they don't. You see how much they make in a year? They supposed to be making what, like 80,000 a year? They millionaires, right? Why is that? So they want us depending on politicians? Like, man, that's pretty crazy to me, right? Yeah, you back, guys? Yeah, so like that's why, yeah, like making 200,000 a year, but they got like $5 million in their bank account. Their home is worth 200K. Yeah, it's like pretty wild, man. All right, so let's go through this, you know, so I could give you guys the explanations, right? I don't see EU going up. What time frame are you on? All right, so we're gonna go through this so like you guys could understand the Fed's outlook. All right, so we're gonna go through a hawkish scenario, what to pay attention to if we're going to see a hawkish scenario, and also a dovish. All right. So right now we already got the 25 basis point cut. We got the expectation of quantitative tightening ending. So we already understand that. So now in order for future forward guidance, right? In order to get a hawkish reaction, which is going to be stronger dollar and weaker equities, right? And weaker gold. The forward guidance has to signal to us that there's going to be fewer rate cuts in the future. So if the Fed signal, right, that they're not looking to cut aggressively, they're going to be more data dependent, right? He's already confirming that inflation is still high, still sticky, right? The delay, also this right here, any delay of the government shutdown, if that's making them stay cautious, that could cause a hawkish reaction too, because the government shutdown is what's stopping them from having a good view on the economy, right? So if they ask him on that question, his comment on that is going to be important, right? So let's see what he says with that. When he speaks on labor, right? If he said as that the labor markets is still tight, that wage pressures is high, unemployment is rising, but we're not at the lows, right? Layoffs is not aggressive, right? This would still signal that they still need to keep rates higher for longer. He's going to use the word like restrictive, right? We got to keep rates restrictive. If we hear some tone like that, restrictive, high for longer, data dependent, higher inflation, right? That would signal forward guidance, fewer rate cuts. Okay. If inflation, he talks about inflation. He's saying that inflation is stalling, right? He see inflation is still high. Any example, tariffs is causing global tensions, making inflation higher, which I doubt he would go there, but that would cause obviously more expectations of rate pauses. If he says growth is cooling but not crashing, the economy is slowing down but not breaking, right? He avoids any bit of recessionary fears, right? That is going to be obviously a hawkish reaction. But what we focus on, right? I want to see if he says anything about the government shutdown. If he says that this is making them act more slowly, being more patient, then this is where we expect, right? Stronger dollar, stronger yields, weaker equities, right? So remember, the government shutdown is that he likes to avoid politic talk, but eventually I think they're going to give him a question on it. They're going to tell him and say, hey, like, is this government shutdown impacting your decisions, right? So whatever he says about that afterwards it would lead to probably where this meeting is going to go. If he says like, hey, we still have enough data to make our decisions, that will probably cause a dovish reaction. So I'll go to that first. But remember, a hawkish reaction, this is going to go against what the markets expect. So if we get any of these things, we'll probably will see equities push lower. We'll see dollar push higher. Gold will push lower as well. All right. So just remember that. Remember these things. Now, the dovish outlook. We already got the cut. But if we want more of a dovish reaction, because the market's already been acting dovish for the past 6 to 8 months, right? So we need an aggressive, more signals of rate cuts, more aggressively. So the forward guidance has to be the opposite, right? We want to hear him talk about more cuts is likely going to happen in the future, right? He's talking about downside risk and the shutdown uncertainty, right? He acknowledged the uncertainty, but it just doesn't affect their decisions. Okay. So we focus on that. If he says that the labor market is trending up, right? Because unemployment, when it's trending up, more people is losing their jobs. We already know that Amazon is letting go 30,000 people. If we see a trend of other jobs doing it, that would cause unemployment to rise, right? So if he says that unemployment is getting worse, wage growth is dropping, right? This is a signal because the labor markets is what they focus on. So if he sees that the labor markets is easing, that's what's going to cause more of a dovish reaction, okay? Because if people ain't working, inflation is going to go lower. That's just how it works. If he shows confidence in inflation, he expects inflation to still hit their target goals. Even though that he expects this inflation print to rise, right? This is only, to him, this is only showing, this is just temporary. We're just dealing with a temporary rise of inflation. If he says something like that, that would most likely cause more downside in the dollar, right? So that would be a dovish reaction. If he talks about the government shutdown, right, that the government shutdown is causing a problem, that will probably cause more like emphasis that the markets would start to care once the central banks acknowledge it. All right. And that is where we will get weaker dollar, weaker yields, upside in equities and upside in gold. That will be the reaction that we will look for a dovish reaction. Okay. From his comments. So that's what I want to show you guys. Like so far we got here, the balance sheet is the quantitative tightening is stopping December 1st. And usually this is the statement. They use the same thing, right? So they just find whatever algorithms that they use. They just put it together. They just take out words that was said last meeting and what they said this time, right? So you can just see that indicator suggests they took out growth, but they put indicators suggest that economic activity has been expanded in a moderate pace, right? So they took away moderate in the first half of the year. So job gains has slowed this year and unemployment has edged up, right? But they took out remains and put remained low. So this is still showing that the labor markets is slowing down, but gradually. This is what they want. So this is not going to cause like market fear. This is not recessionary. They want to see a slowdown in the labor markets, but still gradually. Okay. So that him toning it this way and wording it this way is what's stopping equities from free falling from a recessionary reaction. Make sense? So throughout August, more recent indicators are consistent of these developments. Inflation has moved up since earlier this year, but remains somewhat elevated. So this is hawkish, right? So he's still saying inflation is still elevated. So that's not showing us confidence inflation is going to push lower. Okay, so nothing here. Dual mandate judges that downside risk to employment has rose in recent months. So instead of risen, he showed recent months. So that's most likely showing that downside risk is showing. All right. So the committee has decided to reduce and conclude the reduction of its. All right. So this is where he changed up all of this. So this is what's bigger, right? So they're stopping QT, but it's already expected. But as at least you guys can see here, and now right in the bottom, this is the voting members. So you can see they took out Shermit and where's Myron? I don't see Myron's name there, but that's how you know. Like, so all of this is already expected. So you guys know that they give it to us. All right. So now we could watch the meeting together. Just so that you guys know that it's not guessing.
I will have more to say about monetary policy after briefly reviewing economic developments.
Yeah, let's get it. He's live.
Figures suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand.
So we're getting a hawkish reaction so far. Stronger dollar, stronger yields is causing gold to push lower because he confirmed inflation is still higher.
Should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks.
All right, so that's what I mean. He's going to say a hawkish and dovish comment. He's coming off hawkish because he's saying tariffs is impacting higher inflation. So it's making them be more data dependent. It's making them more cautious. So this is why we're getting this hawkish reaction right now.
Conclusion, far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has
so
been
he's
to
surprised
stop
everybody. He's being actually more hawkish and data dependent. So we're seeing the reactions right now. This is the hawkish reaction.
Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates along with
he's
more
not
use of our
confirming
standard
December's
repo
meeting,
facility.
right? So this is what's causing
In
a
addition,
hawkish
the effective
reaction
federal funds rate
because markets was
has
already
begun to
expecting
move up
December to be a
relative to the
cut,
rate
and
of
he went
interest on
against
reserve
it.
balances.
So now he
These
surprised us with a
developments
hawkish
are what we
statement.
expected to see as the size of our balance sheet declined.
He said
and
December's
warrant
cut is
today's
not for
decision to
sure,
cease
far
runoff.
from it. So this is why we got stronger
Over the
dollar and
3.5
weaker
years
equities
that
right
we've
now.
been shrinking
So
our
this is
balance
the
sheet,
reaction.
Our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase
Makes
of our
sense, guys?
normalization
So
plan
y'all see
by
the
holding
reaction now.
size
This
of
is
our
because
balance
he's
sheet
not
steady for a
confirming the
time,
December cut.
while reserve
But he still got
balances continue
Q&A
to move gradually
afterwards,
lower
right?
as
So
other
he could change it up at
non-reserve
any time.
liabilities such as currency
But this is
keep
supporting
growing.
this reaction.
We will
So he
continue to allow
confirmed
agency
higher
securities to
inflation
run
because
off
of
our balance
tariffs,
sheet, and we'll reinvest
and
the
now he's
proceeds from those
confirming that
securities
December is
in
not.
Treasury
We don't
bonds,
know what we're going to do in
furthering
December.
progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio
Exactly.
closer
Thank
to
you,
that
Lou.
of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee.
I ain't gonna lie, I bought the shit out of you,
Everyone
Jay.
works very hard
But,
at this and
yeah,
takes
he's
their
confirming it
obligations
now.
to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, as a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher
Yeah, this is
inflation.
going to be the direction. Him saying
then
that we
that has
haven't made a
changed
decision
now.
on December.
And as we saw,
This is why we got this
particularly
reaction.
After
So
July
hawkish
meeting, we saw
reaction,
the
higher
downward
inflation,
revisions in
no
job
decision
creation.
on December
we saw
being
a very
a cut.
different picture of the labor market and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion.
Trump are going to be pissed.
I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth.
Yeah, you took gold
rises
sales.
in
Good job. Yeah, good job,
stock
MJ.
prices
Yep,
related
this is
to
the direction for the
AI.
session.
Thank you.
Bitcoin dropping
I wouldn't
because
say
we got
that's
stronger dollar.
That's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other.
All right, so just to recap. So he literally just came out and confirmed, just to show you guys, right? He just came out and confirmed that inflation still remains elevated. So he confirmed higher inflation, and then he's not confirming additional rate cuts. So he made it certain that December rate cut is not for sure. So this is a dovish reaction that we wanted to see, because he went against being hawkish. He went against being dovish. So he's not dovish enough. He's not confirming additional rate cuts. He's not saying inflation is lowering. So he did the exact opposite. And for him doing that, right, this is why we have dollar gaining strength. The yields is pushing higher. We can see that gold finally broke that area of support and pushed lower. We see that the yields are pushing lower. So this is a hawkish reaction, because now the markets, as we can see, bets for the next meeting in December, it was at 90% for a cut. Now they pushed it down to 71% because of what he just said. So this is the reaction for the meeting right now. So this is it, right? So I don't expect him to say anything else after that. This is the reaction. And then now we're going to have to rely on data, which is expected, because why he's going to make a decision in December when they don't have the eyes to see economic data. So you could just see, like, he's not going to blame the government, but don't it make sense that the government shutdown, right, could impact the decisions meeting? So I don't think he's just saying that, but he's saying inflation is being higher because of tariffs. So that's also something we just have to be aware of too. And that's why I think Trump is going to come out and say something.
The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice. And so there's not a lot of benefit to be holding on to get the last few dollars, because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility
This is
of
a good
secondary
question.
effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, and we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that.
He's
So
now
that does give
confirming
you some
tightness in the
comfort.
labor market. So that's another
But if this
hawkish comment.
shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability
It's
to
another
assess
good
the
question,
state of
too.
the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity, and we'll have a picture of what's going on. We also will have the Beige Book again, I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman,
He even said it. The
CNBC.
shutdown would temporarily weigh
Sherman,
on
can you
economic activity.
characterize the meeting in
So-
terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly
Anybody's in any trades?
differing views were really about the future. What does that look like? And I think people
UJ,
are saying,
good job.
they're
Anybody else?
they're
Who took
noticing
equities?
stronger economic activity.
Gold?
Forecasters generally
Gold sells, gold
broadly
sells.
have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's
GCAD?
it's not
Yeah,
clearly
good.
in motion.
Gold
It's not
selling out.
clearly
Yeah, good.
declining
Damn, good
quickly
job,
in any
guys.
case. It may be just
Yeah,
continuing
like
to
that shit was
gradually
easy,
cool.
right?
And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet,
Nelson buys. Yeah, good job, man.
if you
Gold
stop
sells,
it,
sells.
the runoff
NASDAQ.
now, does that mean you have to go back to actually
Would you say be patient?
adding
Nah, I think.
assets sometime
I mean,
next
after,
year
yeah.
so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further
Oh, Terrence, that's a good
shrinkage
buy,
in
dude. You still
reserves.
holding on
Reserves
to
is
it?
the thing
Oh,
that
especially
we're-
now
that
with
we're
the
managing that has
stronger
to be
yield,
ample.
it's going to weaken the
So
yen.
that'll
I'm still
happen for a
holding
time, but not a
GBP
tremendously
AUD
long
sales
time. We
too.
don't know
So
exactly
that's
how
a
long.
great
But
hold.
at
You
a
can
certain
see how that
point,
could turn to
you'll
a swing
wanna
trade,
start
right?
You want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into
listen
three
to what
components.
he's saying here.
So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news, that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that.
Housing
now
is important.
It's been
That's
doing
where
that for
sticky
some time.
inflation
We expect
is.
to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year.
So to me,
at
that's
making sure that that's
dovish,
the case,
right?
and thinking carefully
Because he's
about
saying
what
it's
are
a
the-
one-time
What are the
increase.
pathways through which it could become something else, troublesome inflation? One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services
And then he just
inflation,
reworded it
what are
after.
some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say that first.
The stubborn services inflation that you mentioned.
Service inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible
Yeah, he's
commitment.
using cooling,
And
yep.
There should be no question that that's where we're going.
Chris.
Yeah, so he pretty much just saying that we're doing a good job. Hell, what Trump is saying, that Trump is the reason why we're still staying restrictive because the tariffs is impacting price goods. So he's saying it's one-off, right? Yeah, he's saying that inflation prices is going to rise one-off because he's thinking that the tariff hasn't really fully hit yet. So once it fully hits, it's like Australia, how that big jump has happened. I think he's expecting that to happen in the U.S., but to like services, right? Goods. So that's why he's staying restrictive. But if he's keeping that tone, right, this is why we got that hawkish reaction. But him also saying that it's one-off is temporary. So why he's not going to hike rates. So this is why I still feel him saying that it's temporary is still dovish overall because it's temporary. He's not expecting inflation to rise long term. But yeah, I think Trump I think Trump is going to come out now and lose his shit. So I think that's going to be very
I
entertaining.
think that the spending that
Yeah,
happens
so,
to build data centers all over
I mean,
the
you should have
country
took your
is
profits
especially
already. Gold
interest-sensitive.
dropped over
It's
100
based
pips,
on
guys.
longer
Like
run.
it depends.
It's,
Like take profits is up to
longer run
you. I even
assessments
did a
that this
video
is an
on where to
area
take profits
where
at.
there's going to be
But the moves
a lot of
happen. You can see
investment.
like NASDAQ. Like the reason why I wouldn't sell NASDAQ because like this is just like temporary moves. Because overall, they're going to cut rates anyway. That's the bigger picture. They're going to cut rates anyway. Nvidia, trillions of dollars in stock, positivity, right? Earnings are still well. We see that what Apple, what they hit like 4 trillion, like what Apple did, right? So NASDAQ, like overall, longer term, still a good buy, right? So this is just setting up better buy positions for long term. But now we have to track upcoming economic data. You got to focus on upcoming inflation, labor data to see what's going to happen for December's meeting. Because as of right now, markets is probably going to be 50-50 into a cut or pause in December. So that's what we're going to have to focus on moving forward. All right. So like still as of now, that's, yeah, if we get the data too, because the government shutdown, that will probably cause a recessionary reaction. So yeah, you got 70 pips. Yeah, good job, guys. So I would expect now, right? I still expect this hawkish reaction to hold because he's not saying anything for us to expect anything opposite, but it might push lower and then consolidate. So just be cautious of that, guys.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the beige book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our job.
Yeah, there's no NFP next week. No.
If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things.
You just said it again.
We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
You see, he's saying let's slow down because of the government shutdown. So this is another hawkish reaction.
Announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So,
all right, guys. So he pretty much said it all. Like, good job for you guys that took advantage of the markets today. Hopefully you guys made some money, made some good profits, really good reactions. I do expect, it's a possibility that these reactions might hold because he's confirming everything that we want, that he is not being overly dovish. Okay. So I would expect stronger dollar, right? I will expect equities to push a little lower or consolidate, right? Same thing with gold, because equities is the overall stock market and stocks is doing extremely well so far. But this is a hawkish reaction because he's saying that we're not getting the data to really help us decide what's going to happen for December. So now Marcus is now going to start expecting a possibility of a pause. So the longer the government shutdown, hawkish reaction. Make sense? So the longer the government shutdown, possibility we could see growth also take an impact. So I'm thinking maybe mid-November, if it still lasts till then, we're most likely to start seeing a recessionary reaction. All right. So hopefully this is helpful. Again, guys, if you guys are interested, join the private group, right? All the questions that you have, it gets answered here. Most of these guys, they understand what to do, right? You can see they took advantage of gold sells. Some took advantage of equity sells. As you can see, this week, all I took was Australia's inflation data was yesterday. I took advantage of the strength of AUD. I took pound AUD sales, which I'm still holding on to. And then right now, today, I just took advantage of UJ buys That's how I build consistency. I wait for reasons to take advantage of good trades. And this is what we all do here, right? This is how we build consistency in the markets. Right here, 7K in profits done for the week. So good job, dude. But this is how you build consistency. This is why I'm able to stay ahead, is because I pay attention to what moves the markets. So once you understand what moves the markets, this is how you can start trading with confidence. All right. This is how I know what happened today caused a hawkish reaction. This is how we stay on top of it. This goes for every currency too, right? We're able to have, like right here is where I tell everybody about the important headlines, because it seems like it's a lot going on. So now over the market update later, I'm going to clear it up so we could exactly know what actually happened that moved the markets, right? And this is what we do every single day. But this is how it started. We got this right here. We got the hawkish outlook, right? Because he confirmed, right, that they're going to, he confirmed that there isn't going to start an aggressive cutting cycle, fewer rate cuts. He said that by December, like not cutting in December. We could see that delayed data, right, of the government shutdown. He said it exactly, word for word. Fed must be cautious because the delayed data of the government shutdown. We also see here about what he said about inflation. Like inflation is rising, upside risk due to tariffs. So he said that. So everything that happened today was a hawkish reaction. And you see expected direction, stronger dollar, stronger yields, equities, and gold push lower, right? So that's how we are able to use this type of information to look for trades. Okay, so it's not a guess. Make sense, guys? So this is why we see these reactions now. And then when I do the trade ideas, it's following the green because green is hawkish. So now we got stronger dollar, weaker gold, weaker equities. So everything could have put a 1 if you guys are clear. If you got questions, let me know. I'll give you guys like 2 minutes. But today was easy, you know, so that's what he confirmed. We understood what to pay attention to. He said it. Markets react in that direction. Like the only way you could be totally wrong is if somebody is trying to sell gold at the highs. Like somebody is trying to like stuff like that. You know, somebody's trying to sell dollar at the highs. Somebody's trying to buy gold right now. Like that's the only way. You're guessing, right? So this limits the guessing because now it's going to move based off our expectations. All right. No, gold is just pushing lower. Equities are lower. I explained everything so far. Yeah, if you're on YouTube, go on Instagram, go on YouTube. You get a better view of everything. I'm about to buy the car I always wanted because of this group. Thanks for that, dude. Yeah, man, I'm happy for you, brother. Yeah, good job, MJ. All right, guys. Have a good one. Hopefully this was helpful. See y'all later. Peace.